We're talking about Amazon in this video. Amazon reported earnings. They beat on revenue. They missed on earnings per share. They provided guidance that was above analyst expectations, and the stock is up 10%. Let's jump into the report. We'll talk about the results, and we'll talk about some price targets or some buy prices that I'm thinking about moving forward. All right, everybody, if you've watched this channel at all before, you know I believe in transparency. I am building a $10,000 to $1 million portfolio right here on YouTube and sharing every step of the way. We are currently at a value of $74,100. It's Friday and the market's not open yet, so this number will update. We have put in $82,500. We're down $8,300 total. Over the last week, we are down $3,882 total, and we've put $8,500 into the portfolio this week. Here's a quick look at the companies I own. You can see Amazon is not in this portfolio, so I have no interest in Amazon in terms of an investment at this time. If you want more detail on the stocks that I own and buy alerts before I buy them, check out my email newsletter, austin.substack.com, where I send those emails out before I buy any. There's a link down in the description if you want to check that out. Let's get to Amazon. So Amazon shares accelerate as analysts applaud the earnings result. According to Wall Street analysts, largely encouraged by the report, there could be significantly more upside ahead yet. We're gonna actually look at some calculations, and I'm gonna tell you if I think that is potentially the case or not. Here's why the revenue was as strong as it is and why the stock is responding the way that it is. AWS, Amazon Web Services, acceleration and strong top line growth overall was the key factor fueling a spike for the stock. Despite a net loss that reflected continued pressure from the company's investment in Rivian, a surge in net sales from $14.8 billion in 2021 to $19.74 billion for the reported quarter carried optimism forward. Management was also keen to point out historic acceleration during the Great Recession as a lower cost cloud option to assuage cyclical concerns on the business. And so what they're saying is that businesses will continue to be incentivized, their customers, to transition to the cloud, to start using Amazon Web Services because it saves them money in recessionary or inflation type environments. That's what that comment is saying. Wedbush analyst Michael Pachter reiterated his buy and set a lofty $175 price target. And Amazon right now is at $122. So that's 30% upside, maybe more. Here's a quote from the analyst. Longer term, Amazon should benefit from steady margin expansion driven by the rapid growth of its cloud and advertisement businesses. What will likely surprise investors was the ongoing strength of Amazon's advertising unit, which set another record in the quarter and is showing no signs of slowing, he told clients on Friday. Compare that with the commentary unfolding across digital and connected TV, and the results stand out even more, which we suspect owes to Amazon's broad-based content strategy and massive data lake. Here's the thing is Amazon is able to offer advertisements, sponsored ads on its own site where people are actively looking to purchase things. They are going to Amazon to either search for things or purchase things immediately. When you can offer advertising space at that prime digital real estate versus we saw Roku. Roku got crushed. I'm going to do a video on Roku. They're struggling in advertising. When somebody's sitting there watching connected TV, showing them ads is great, and it has worked during good economic times. But if you think when customers are having to cut advertising budgets, where are they going to prioritize? They're going to prioritize the highest value places, and the highest value places are where people are actively looking and thinking about buying. Not when they're potentially not even paying attention on TV or streaming TV or relaxing on their couch trying to go to bed or whatever. And here's another analyst talking about downside potential has been de-risked barring a deep recession for Amazon, and any short-term volatility should be ignored as the long-term trajectory remains extremely attractive. We shouldn't just blindly follow analysts. So let's start to get into whether or not Amazon looks overvalued or undervalued right now. This is Fast Graphs. I'm a paying customer. This is not an advertisement. Couple things I want to point out about Amazon in this chart right here. Right now, this is showing back to 2004. And we can see over here, this is the average earnings growth rate over that entire period. Average per year, it's grown 24.5%. Its normal PE has been 126. That's also something we kind of ignore with Amazon because they have not had a positive EPS for most of that time, or they were growing off a very small number. And so that's not traditionally how Amazon is valued. So a better way to value Amazon is price to operating cash flow. That's the cash flow brought in from operations. And we can see that over this same time period, Their operating cash flow growth rate has been 29.69%, and their normal price operating cash flow is actually below that growth rate. It's been 25.67%. So this starts to look at, hey, there's some different ways we can value different stocks. If we look back, it's actually very rare that it trades below that average price to operating cash flow, right? And so we see the growth rate's been about 30%. Well, the next 3 years, it's expected to be 48, 42, and 27. These numbers will likely come down a little bit, but still, it's expected to be stronger than its historical growth rate, right? But let's shorten this time frame a little bit. Let's go back to 2016 and let's see how these numbers look. So normalized price operating cash flow about 26, and then the growth rate still 28%, and it's still looking strong going forward. So if we wanted to take it out and we looked at this blue line, if it got back up to the average, that annualized return would be 48%, and then 159% total through December 2024. All right, now we've extended this time frame out a little bit more. We're still looking at price to operating cash flow, but what we've done is we've added the analyst expectations through 2024 for 48%, 42%, and 27% growth, and then I put in 20% for 2025, 20% for 2026, and 20% for 2027. If we take that price out and we bring it down from a blended price operating cash flow today of about 21 to even 12 in 2027, you're looking at a 14.6% annualized rate of return for a total rate of return of 109%. That would be pretty impressive. That's price operating cash flow. But as we get further out, Amazon will likely eventually be valued on a price to earnings basis. And these are just guesses, they're just estimates, right? But we've got the analyst expectations in here, and this is for earnings growth. Minus 81% for 2022 for this year is what is expected. 327% growth in EPS is expected for 2023. And then 48% is expected for 2024. Those sound like huge numbers, but if we look at the adjusted earnings, we could see that in 2021, it was $3.24. That's only expecting it to be $3.75 in 2024, just barely getting past 2021. So even though this looks like an absurd number, it's really not that absurd. Then we've taken it to 20%, 20%, and 20% for the next 3 years. So right now, the blended price of earnings is 71. That is not going to continue. There's no way that continues over time. It's just way too high. The market on average is 15, 16. So I've put in 20, and we can look at 14, we can look at 10. What happens in those scenarios in 2027? And this is where the dynamic for Amazon might change a little bit. If we go to 20, which I think if they're growing at 20%, that could be fair, that could be low, but you're only looking at a 1% annualized rate of return from now to 2027. If you bring it up to 24, which I think would be kind of the maximum on the high side that I would imagine it deserving at that time in 2027 when it's such a large company, it can't be valued like a unprofitable growth stock forever when it's not still a growth stock. So I think 24 is like the high side for price earnings in 2027 for Amazon. Then you're looking at a 4.5% annualized rate of return. If it gets down to 14, then you're looking at a negative 5% annualized return for a minus 26% total loss. All right, if we wanted to take this analysis one step further, I also subscribe to Everything Money, to their stock analyzer tool. I like that they've got this 8 pillars broken down, kind of the 8 things they look at in stocks. Amazon doesn't score very well on this 8-pillar analysis, which looks at the 5-year price earnings ratio being under 22. It looks too expensive. The 5-year return on invested capital is low. They have grown revenue. They have grown net income over the last 5 years. Shares outstanding are up 6.7%, so that gets a red mark. Long-term liabilities to 5-year free cash flow of under 5, it's at 16. A value indicator, and this is overvalued. I would expect, again, Amazon to show as overvalued. So I'd be okay if those were the only things, but they get a lot of red marks. The cash flow growth for 5 years is actually negative. And the 5-year price to free cash flow of under 22, it's actually at 146. So another way we can look at Amazon, that I was just looking at it on sort of the graphs with fast graphs, but we can also look and make assumptions in this tool. This is looking at a 10-year analysis. I've given a low, a medium, and a high scenario. On low for revenue growth, 8%, medium 10%, high 12%. Profit margin, 4%, 6%, and 8%. And that's actually above their profit margin historically, because I think that more of it will come from AWS, which should be a higher profit margin over time. So I'm giving it a little bit of an adjustment up there. Same thing with free cash flow margin. It's been 2.9% over the last 10 years. I'm giving it 4, 6, and 8 because of that transition to more software. PE is 64 right now, it's showing. And I put in 20, 25, and 30, which I actually think is a little bit high 10 years from now, but we'll give it that and see what happens. Price to free cash flow, I did the same as PE, and then desired annual return, 13%. Let's see what happens. In this scenario, it's actually showing that Amazon is overvalued in every situation except for the high scenario. So if you believe this high scenario to be true, Amazon might be interesting to you right now, but it's close to that high end anyways. It's at 133 and the high is 138. And so, what you can do in here is you can add things to your watch list. I'll put a below 78 on my watch list. And I know that seems extreme, right? But again, I am interested in companies that I think can grow more and for longer than Amazon. And so that's what I'm gonna orient towards. If Amazon was a lot cheaper, I would certainly look at it, but the growth is just not there for me to be interested in Amazon over some of the stocks that I own that I think could grow for a lot longer. If you like this content, do me a favor, like the video, subscribe to the channel. It helps other people find us, and it helps the channel grow.